Since the start of the year, investors have had a lot to deal with. From the Middle East conflict to broader geopolitical uncertainty, tensions are high. But here's the thing, crises rarely create new trends from scratch. More often, they accelerate ones that are already underway. The era of abundant capital is gradually giving way to competition for investment funding. Or in other words, moving from savings glut to savings grab. So investors should not retreat, but rather reposition. We remain constructive, economies are still growing, and setbacks should be used selectively. One thing is for sure, investors should not sit on the sidelines.
In equities, the AI story is moving from hype to generating revenues and earnings growth. But it still needs huge investment to keep growing. At the same time, governments are spending on defense, energy systems are being redesigned, and companies are reshaping supply chains closer to home. We still think it makes sense to diversify beyond the US, although there are exceptions, like AI, where US companies are still leading the pack. That also means taking a fresh look at Europe, where we prefer countries such as Italy or Spain rather than Germany or France. For those able to sustain higher risk, we remain overweight emerging markets versus developed markets, with selective AI, biotechnology and electric vehicle exposure in China. Inflation is expected to remain elevated but stable, and as pressure on oil prices is likely to ease over time, high-quality bonds should benefit most. One thing to keep in mind, bond duration is no longer a set-it-and-forget-it decision. It's something to actively manage. In foreign exchange and commodities, the old story of oil driving the US dollar isn't as strong as it once was. We expect the US dollar bear trend to resume over time. Finally, gold's rally should reassert itself despite several strong pullbacks seen so far in 2026.
As we head into the second half of 2026, with US midterm elections coming up, ongoing geopolitical tensions and inflation relatively well anchored, the message is simple. Stay invested, but remain open-minded and flexible. Use market dips as opportunities to adjust or add to positions. Just don't sit it out.